If you were to take a look at all of the funds that, there's a database called Preqin that tracks all of the venture funds in our industry. There's about 1,000 funds that they've been tracking since 2006. How many funds, of that 1,000, how many of those funds do you think returned 5x or more?
2%, 5% of those?
Right. So total of that 1,000 is a good question. It was actually much less than that. Actually, of that 1,000, only 10 actually returned 5x or more. Of those 10, 6 of those were international funds.
And you have to remember, as an LP, and I'm an LP in a number of funds, in addition to having founded 2 small micros. You want to charge your management team, your GP team, a fee for the illiquidity of your fund, right? So unlike buying an S&P ETF, S&P 500 ETF, where you can sell and get access to your capital and returns anytime you like, your venture fund, it's locked up. It's not even like a hedge fund, which may have gates you can get your money out over a year. A hedge fund, a venture fund works very differently, much like a later stage buyout fund. You get your capital gets called over primarily a 5-year period. It's called the investment period, where the fund's making initial investments, and then smaller amounts will get called in perhaps a second 5-year period on the back end of the life. In the meantime, the only returns you get are when the fund actually invests in a company and brings it to liquidity and sells it. So you do want to charge a illiquidity premium on your money. It should perform better than the S&P 500. You want some sort of premium over it. I think most funds that I see, my law firm does a lot of fund formation work. We work with Somak on his funds 1 and 2. Most funds market that they do a high teens IRR. Now, Somak mentioned that it may not be the best performance measuring stick. I don't like IRR as a performance measuring stick because people tend to use their illiquid positions mark to market. There's a FASB rule, 157, it's an accounting standard that requires venture funds to mark their positions to market, to report their financial statements in accordance with GAAP. And you see a lot of companies that are marked up that may have turned the corner and be having some real difficulty, and not only not be able to raise money at that valuation in the future, but maybe raise capital at all. So the IRR takes into account where companies have marked their portfolio. There's some other measures that we're going to get to in a moment that I like better. DPI, which is it really measures the amount of capital invested and how much has been returned in that percentage. I think most people would say that if a fund had reached 2x, that was a quote-unquote venture type return. Now that's 2x again over 12, maybe even 13, 14 years. So you're not going to get all that money back in one big.
I'd say at least 2x. I mean, it's definitely not 5x. I would say somewhere between 2 to 3x. I think for us, when we look at how we benchmark our success, we'd like to try to achieve at least 3x, because once you factor in fees and expenses, you're getting to actually something closer to 2.5x. And back to Ed's point about the illiquidity premium, all the other areas where you could put your capital, if you could get 2x in private equity, if you could get 2x in hedge funds, and then over a shorter time period, why would you invest in venture? So I think it's more exactly Ed's range, like 2 to 3x cash on cash.
2 would be sort of the minimum above which people would start to say, okay, this is a good fund. I'd also add that as you think about funds, you might, if you commit $100,000 to a fund, not all of that $100,000 obviously is going into the portfolio itself. There's a management fee that's got to be paid. There are expenses for the fund formation, for the deals. So I generally, as a rule of thumb, tend to think that maybe 70% of the capital that is committed to a fund by its LPs ends up actually going into the portfolio company securities.